So you should have already covered the details of these accounting standards in your studies for the financial statements exam. These slides are going to help as a bit of a memory jog of the main points to bear in mind when answering questions in the exam, and also there'll be a few example calculations similar to those that are likely to crop up for you to work through at the same time. So the three questions take on a very different form. Task 3 deals exclusively with the conceptual framework document, so you might get questions about the purpose of financial reporting, the definitions of assets, liabilities and so on, and the qualitative characteristics. Task 3 will also include some questions about ethical principles, AAT principles and so on. Task 4 is a written question, and you are expected to apply your knowledge of accounting standards to a particular scenario, and it might, for example, be the directors of a company wanting to capitalize some development costs, and you have to advise them as to whether that's possible or not based on the information that's provided. And finally, task 5 is more of a computational question. It's in task 5 that you'll probably get questions about calculation of inventory values under IAS 2, impairment adjustments to assets will be in task 5, and also if you had financial statements to prepare in tasks 1 and 2 rather than a cash flow, task 5 might also include questions relating to the cash flow statement as well. So task 3 is all about basics, the conceptual framework and some basic definitions of assets, liabilities and so on, as well as some ethics, taking you back to what you covered in level 3 in the professional ethics paper. So these slides are just a reminder of some of those main things that might crop up in the exam. So what are financial statements all about? There are two definitions here, and it's important not to confuse the two. First of all, there's a definition of what financial reporting is for. That's contained in the conceptual framework, but there's also a definition of what financial statements specifically are for, which is contained in IAS 1, and it's important not to confuse these, but they're basically saying the same thing. The purpose of general financial reporting, there's the definition there from the conceptual framework. It's to provide financial information that's useful, and that's an important thing to remember. You don't want to include irrelevant information. The information in the financial statements has got to be useful to people making decisions about providing resources to the entity, whether it's existing shareholders deciding whether to sell their shares or not, or new investors or banks looking to invest in the business. So it's to provide information that's useful in making decisions. The purpose of financial statements, that definition is slightly more detailed, and there it is from IAS 1. It's to provide information about the financial position, that's the statement of financial position, the financial performance, that's the profit and loss account, and cash flows, which is the cash flow statement of the entity, useful in making economic decisions. So that's the one thing that's common to both definitions, is that they have to be information, figures that are useful in making decisions about investing in the company. So as long as you include that, whatever the definition is, you'll get most of the marks. But the definition of financial statements is more detailed than the definition of financial reporting. So just bear that in mind. We then look at what makes a good set of financial statements, and those are defined in the qualitative characteristics listed in the conceptual framework. And remember, there are two main characteristics of good financial reporting and 4 enhancing characteristics, so 6 altogether. And the 2 most important ones: the information must be relevant, and that means relevant to the decision-making process. That's why the profit and loss statement isn't as detailed as statements prepared for sole traders and partnerships. The overhead costs and cost of sales are very much summarized because the detailed information wouldn't really affect the decision-making process. So the information contained has got to be relevant to decision making, something that would affect someone's decision to invest or not in the business. And then faithful representation. The figures have got to be presented in a way that doesn't mislead the person looking at those statements to come to wrong conclusions about how financially sound the company is, how profitable the company is, and so on. Those are the 2 main qualitative characteristics. And then we've got these 4 enhancing characteristics. Comparability, that means that you've got to use the same valuation methods and so on from one year to another. You can't last year use average cost for valuing inventory and then this year use first in first out. You've got to use the same method year on year so that the figures are comparable. They've got to be verifiable as far as possible. How can you check that those figures are correct? They've got to be supplied in a timely manner so that they're relevant to decision making. And finally, they've got to be understandable, and that means that the figures have got to be supported by fairly detailed notes detailing how the figures have been arrived at. So you'll be told the method that's been used to value inventory, you'll be told the rates of depreciation used for working out the cost of benefits used up in the period, depreciation, and so on. So those are the qualitative characteristics, often appear in question 3 as a tick box question. So you've got to remember those 6: relevance, faithful representation, comparability, verifiability, timeliness, and understandability. The other very important thing that's contained in the conceptual framework are definitions of the elements of financial statements. And remember, we've got 5 of those. Assets. Remember, the definition doesn't require ownership, only control. So an asset is a resource controlled by the entity that is going to produce future economic benefits. So it's something that's controlled by the company that's going to be used to produce, usually produce profits in the future. Liabilities, present obligation arising from past events that are expected to result in outflows of economic benefits, usually cash flowing out of the business, but it could be the provision of services, the provision of goods in the future, and so on. So it's a present obligation, and remember that obligation can be a legal obligation, something that could be pursued through the courts, or a constructive obligation that's based on past behavior. We've then got the definitions of income, expenses and equity, and these go back to the accounting equation. And the definition of income is basically saying that if asset values go up or liability values go down, the result is going to be an increase in the equity value. And so that's treated as income. So anything that increases assets or reduces liabilities, that's going to result in an increase in the value of equity in the accounting equation, that's treated as income. And then expenses is basically the other way around. If assets go down without any reduction in liabilities, if assets go down or liabilities go up without any change in asset values, then equity must go down, and that's an item that will be treated as an expense. So decreases in economic benefits in either outflows of assets or increases in liabilities that result in the equity total being reduced. So income increases equity, expenses reduce equity. And then finally, the definition of equity itself as basically the accounting equation. It's what's left after deducting liabilities from assets. So those are the 5 definitions that are likely to crop up in the exam, either as part of question 3 or things that you need to build into the answers relating to specific accounting standards, because remember, the definition of assets is repeated in IAS 16, definition of liabilities is repeated in IAS 37, and so on. So important to try and remember these 5. Now, although accounts are usually prepared on a historic cost basis, the conceptual framework allows the accounts to be prepared in 4 different ways. Either using the historic cost of assets, and that's what's normally used, and the financial statements will include a note confirming that that's the basis that's been used. But there are 3 other options as well. Current cost, and it's difficult to remember exactly what these attempt to show. And current cost indicates, as the slide says, that assets are shown at their current replacement cost. That doesn't mean that we're showing the cost of replacing the asset with a brand new equivalent asset. It's valued at what it would cost to replace the asset in its existing condition with an identical item. If it's 5 years old, how much would it cost to replace it with another item that was also 5 years old? So current replacement cost, and liabilities shown at the amount that would be paid if they were settled immediately. So if the liabilities aren't due to be settled within 5 or 10 years, it would be necessary to discount those values down to a present value. So that's current cost, replacement cost. Realizable value is where assets are shown at what they could be sold for in the open market as a single item of inventory and so on. And this is the basis, as the slide says, that should be used if the business isn't considered to be a going concern. If the going concern basis isn't relevant, then realizable value should be used for the assets in the statement of financial position, because that's the only future benefit that's going to be derived from those assets, is the cash received from their sale. And finally, present value, that's the discounted value of future cash flows. And this is the one that sometimes gets asked and people get confused with. Present value doesn't mean what you could sell them for. Present value is the value of future economic benefits discounted to a present day amount. So those four bases are sometimes asked in question 3, and it's where marks are often lost because the bases titles don't usually reflect exactly the method that's used. So current cost is replacement cost. Realizable value is where they could be sold for the value that they could be sold for. Present value is the discounted value of future cash flows. That assumes the business is going to keep the assets and continue using them. So the present value of those future cash flows is what's used there, not the selling price. That's the one that's most easily confused. And then finally, the conceptual framework lists some underlying assumptions that people always assume apply to the figures that they're looking at in a set of financial statements. Firstly, the assumption that the accounts have been prepared on the basis that the business is going to continue in the future. That's the going concern basis, and that's perhaps the most important assumption. If the business is unlikely to be able to continue in the future, then the going concern basis isn't appropriate, and assets should be shown at realizable value because the only future benefit, as I've said previously, is what you're going to get for selling them. So it's assumed that the going concern basis applies to a set of financial statements unless the statements indicate otherwise. The accruals basis, so we're not preparing accounts on the basis of cash received and paid in the period. We're preparing the accounts on the basis of sales made and expenses incurred during the period, whether or not those items have been paid or received. So the accrual basis applies. And materiality, remember the information in the financial statements has got to be relevant. So the conceptual framework says, and IAS 1 says, that anything that's material to that decision-making process should be shown separately. And finally, no offsetting. If you've got receivables and payables relating to the same company, or you've got money in one bank account and a bank loan elsewhere, you cannot set those assets off against those liabilities. They normally have to be shown separately. So 4 underlying assumptions that people looking at financial statements will always assume have been applied in the preparation of those figures. Going concern, the accruals basis, material items shown separately, and no netting off of assets and liabilities. And then the other item that's contained in task 3 of the exam will relate to ethics and AAT's fundamental principles. And remember, there are 5 of those. You've got to work with integrity, so straightforward, not being devious, keeping to the rules as they are. Objectivity, very important. Professional skepticism is a phrase that crops up very often. You've got to question all the figures and all the statements that are presented to you to question whether they're correct. How can you check that they're correct? What could be wrong, and so on. So you've got to be objective. Professional competence and due care. Don't undertake work that you haven't got the necessary skills to complete. Confidentiality, nobody gets told anything except where HM Revenue and Customs have issued a notice requesting information, or where you suspect money laundering, in which case you must notify the authorities. And finally, you've got to behave in a way that doesn't put the profession into a bad view. So 5 fundamental principles there: integrity, objectivity, professional competence, confidentiality, and professional behaviour. And the one other thing that we need to consider is risks to that, particularly risks to that objectivity. And the first of those is self-interest. If you're preparing figures, for example, let's say these 2 people are engaged, they're in a relationship, and this person is preparing the financial statements, and she knows that the figures she's preparing could lead to her partner losing his job. So there's a risk there that she might be tempted to manipulate the figures in a particular way that would be to his benefit. So if there's any interest in the figures, if any friends, relatives, or the individual themselves is going to be affected by the figures, there could be a risk that they're tempted to manipulate them in some way. That's why auditors of companies are not allowed to own shares in those companies themselves. Self-review. If this guy here in the picture is keeping the bank records and also carries out the bank reconciliations, he may be tempted to adjust the reconciliation so that any mistakes he's made are hidden from that. So checking your own work is not a good idea. That's why firms of auditors generally have separate teams, one preparing the financial statements and a separate team verifying the figures. Advocacy. If the team have suggested to a bank that a particular company is a good company to loan money to, and that company's at risk of going into liquidation, then there might be a temptation to adjust the figures to show that the company is as good as they made it out to be. Familiarity. Long-standing relationships may affect the preparation of the financial statements. If you've been dealing with the directors of a company for the last 10 years, you might not want to upset them by producing figures that don't look particularly good. And intimidation. A possible loss of income. This is perhaps more relevant to an employee if the directors come along and tell the employee that they must change the stock figures in a particular way or they'll lose their job. So that's a risk to independence. All of these are situations where the individual might be tempted to manipulate the figures to the extent that they don't show a true and fair view. Self-interest, self-review, advocacy, familiarity, and intimidation. Now, tasks 4 and 5 are all about applying the rules contained in various accounting standards to scenarios or to calculations that you're given. And these slides will contain a few example questions for you to work through as well. One of the oldest standards, and perhaps one of the most important because it deals with the valuation of a major item in the statement of financial position, is IAS 2, dealing with the valuation of inventory. And straightforward enough, as long as you remember a few important points. Firstly, last in first out is not a method of valuation that's allowed under IAS 2. You can use first in first out, you can use average cost, or you can use a very accurate and detailed method of identifying the cost price of various items in stock. But last in first out is not allowed, and each item in stock must be valued at the lower of cost or net realizable value. And remember, we're not comparing cost and selling price here, we're comparing cost and net realizable value. And that comparison must be carried out for each item of stock, not the total stock value. And cost must include, where there's production, it must include an appropriate proportion of production overheads. So items in inventory must be valued on an absorption costing basis. You can't just include the marginal direct cost. You have to include a proportion of production overheads in that valuation. And remember, as I said, we're comparing cost on an absorption cost basis with not the selling price but the net realizable value, which is the selling price less any costs that have still got to be incurred before the item is sold. So any costs still related to completion of the item in production, any costs related to the sale of the item if it's offering discounts to individuals or commission to individuals, all of those costs are deducted from the selling price. Don't make the mistake, as students often do, of adding those costs on to the current valuation of stock or deducting them from the current valuation of stock. They're only deducted from the selling price. So we're looking at the selling price of a completed item, and we're deducting from that selling price the costs that somebody has got to incur to change a partially completed item to a complete item, whether that's the person buying it or whether it's the company before they sell it. So how much would a person pay for a particular item in the state it is at the moment? They would probably look at the selling price of a completed item and deduct from it how much they're going to have to pay to get the item finished. So that's net realizable value, selling price less costs to be incurred in the future before sale. So once you remember those 3 or 4 things, the IAS 2 questions should be fairly straightforward, and there's one example on the next slide for you to have a go at. So here we've got 4 items that we need to work out the value of for the financial statements. We've got a cost figure on a first in first out basis, including an appropriate proportion of overhead costs. We've got some costs still to be incurred to complete a couple of those 4 items, and this is what the eventual selling price will be. So pause the presentation for a moment now and see if you can work out what the total inventory value will be under IAS 2. So if we look at the first item, we've got a selling price of £2,000, a cost to complete of £600. That's deducted from the selling price to give us a net realizable value of £1,400. That's what someone wanting to buy that item might be prepared to pay for it in its present state, in its uncompleted state. because they'd still have to spend £600 to complete the item. So the net realisable value is £1,400. That's less than the cost, and so we take the lower figure for IAS2, and that gives us an inventory value of £1,400. So do remember, these costs to complete are deducted from the selling price. They are not added to or deducted from the cost figure. The cost figure never changes. If we look at the second item, value of 1,850 is going to be sold for 2,200, so that's okay. We can use the first in first out value. The next item, cost is 900. We're only going to be able to sell it for £800, so we never value an asset at more than the future benefit we're going to get from it, and the benefit we're going to get is £800, not 900. So it's the lower of those two figures. And then finally we've got £700 still to incur for item D. That comes off of the selling price to give us net realisable value of 3,200. That again is less than cost, and so that's the figure that we will use for our IAS2 value. That gives us a total inventory cost of 7,250. Don't make the mistake either of comparing just the totals. Don't work out the cost figure and the net realisable value figure, if you like, for the total, which would be 7,600. Don't use the totals. We have to work out each value separately to arrive at the IAS2 figure. So hopefully you're okay with that calculation, which is very likely to crop up as part of task 5. IAS 10 is another straightforward standard, provided you remember just a couple of things. Firstly, the period that needs to be considered. We've got the accounting period year end at this point, and we're interested in anything that happens from that point up to the date that the directors approve the accounts. Not when they're issued to the shareholders, not when the shareholders sign the accounts off at the annual general meeting, but when the directors have added their signature to the statement of financial position. So right up to that sign-off date, we're interested in everything that happens in that interim period. And things that happen in that period are divided into two types of event under IAS 10. Adjusting events, and these are things that happen in this period that provide more information about the true value of assets and liabilities as they were at the balance sheet date. So it's something that happens that gives you more information about the situation as it existed at the year end. And those bits of information should be reflected in the financial statements. So if, for example, you learned that for one reason or another an error has been made in the valuation of stock at the year end, then you should adjust the statement of financial position inventory amount for that. So an adjusting event, anything that provides more information than you had before about the true value of assets and liabilities at the year end. Non-adjusting events, on the other hand, are things that happen after the year end that could have an impact on the investment decision. That's the important thing to remember all the time, is that we're preparing financial statements to help potential investors. And so anything that happens after the year end that's going to have an impact on the business and its performance, but doesn't affect the values of assets and liabilities at the year end, those are non-adjusting events which potential investors need to know about. And in this case, they're not reflected in the statement of financial position, but they must be included in a note to the accounts. So it's actually quite important when you're reviewing a set of financial statements to have a look through those notes and see details of anything that's happened after the year end that might impact on the business. So here's the type of question that you might get in task 5 of the exam. We've got some post-balance sheet events here. Remember, all of these things happened after the year-end date and before the directors had signed off the accounts. So have a look through these, see if you can decide whether each item requires an adjustment to the financial statements or a non-adjusting note to the accounts. So pause the presentation for a moment and just have a read through and think about those items there. So first of all, we've got a defect in inventory that's going to reduce its value by £3,000. Now, although it was discovered after the year end, that defect was already there in the stock at the end of the year, so it was already going to affect the value of the inventory, and so that would require an adjustment to the inventory value in the statement of financial position. The next item, a factory fire, halted production. That's a major event, but it doesn't affect the position at the balance sheet date at the year end. The factory was still there and still in full production at the year end, so there's no adjustment required to the statement of financial position at the year end date. But from an investor point of view, it's a major event that they need to know about, so it's a non-adjusting event that should be noted in the notes to the accounts. Next, we've got a customer that's gone bust owing us £20,000. Now, arguably, if you could show that the only reason the customer's gone bust is because of something that happened after the year end, then you could argue that no adjustment would be required to the accounts. But certainly in the exam, if you get this type of event, then the assumption should always be that if they've gone bust after the year end, they were already unable to make payments to creditors at the year end date. And so we don't want to ever overstate the value of assets, and that money owing to us is a current asset, so we've got to reduce its value to, in this case, to 0. So that's an adjusting event. A new competitor entering the market after the year end, it's not going to affect the year end position, but it will affect future performance probably, so that needs a note to the accounts. And then finally, we've got an asset that was sold shortly after the year end, but it was sold for £10,000 less than its book value. Now, it could be argued that that would give rise to an impairment loss, because if the asset's not used in the business anymore, the only future benefit that the company can get from that asset is to sell it. And we now know that the sale proceeds are £10,000 less than the assets recorded at in the books. So there should arguably be an impairment adjustment for that item. So that's the sort of question you might get in the exam in task 5 for IAS 10. And remember, the big question is whether the event gives you more information about the position as it existed at the year-end date. The standard dealing with tax liabilities is pretty straightforward, and so shouldn't present any real problems to you. Just bear in mind that the tax charge appearing in the profit and loss account is usually made up of three separate elements. First of all, the estimated tax liability based on the year's profit and loss account, and it's important to remember that first word is just an estimate. It's not the final agreed liability with the tax authorities. Once that liability has been agreed, then there's probably going to need to be an adjustment, and that's the second thing that will appear in the profit and loss account, is an adjustment to the previous year's estimated tax liability. So if the estimate was more than the final agreed liability, then there will be a deduction to the charge, a reduction in the charge to this year's profit and loss account. If the estimated liability wasn't as much as the final agreed liability, then there needs to be an additional charge to profit and loss for the difference. So that's the second thing that will appear as part of the tax charge in the profit and loss account. The final item will be an adjustment for what's referred to as deferred tax, and I'll talk more about that on the next slide. But those three together will give the charge to profit and loss. So it's an estimate for the current year, it's an adjustment to the previous year, and it's an adjustment to the deferred tax liability, and those two can be either a positive or negative figure. That gives the final charge to the profit and loss account. And so remember, when you're preparing the cash flow, that's not the figure to take, because it includes estimates and provisions and so on. For the cash flow, you need the tax actually paid during the year. So that's the figure in the profit and loss account. On the next slide, we'll just have a quick chat about deferred tax. So, what is it? If you've studied the tax papers, you'll know that the profit on which tax is paid is seldom the same as the profit shown in the profit and loss statement for a number of reasons. Firstly, certain items will be deducted as expenses in the profit and loss account that aren't allowed as deductions for tax purposes, such as entertaining expenses. And secondly, and most importantly, depreciation deductions aren't allowed for tax purposes, but instead we get allowances for capital expenditure. Those two items, together with others, will mean that the profit on which tax is calculated will nearly always be different to the profit shown in the profit and loss account. What the deferred tax charge attempts to do is to adjust the tax charge to profit and loss so that it is more closely related to the profits that are shown in the profit and loss statement. And the difference will usually relate to allowances for capital expenditure. If you think about the profit and loss account, capital expenditure will gradually be written off in the way of a depreciation charge. For tax purposes, very often that capital expenditure can be deducted in full when the asset is purchased, and that means that in that particular year the profits on which tax is calculated will be much less than the profit shown in the profit and loss account, and that will give rise to a deferred tax charge, because the profits that aren't taxed in that year will eventually be taxed in later years. Because if you think forward, in later years we will still be deducting some of that capital expenditure in the form of a depreciation charge, but because that capital expenditure was deducted in full in the year of purchase, there will be no deduction in later years for tax purposes. So in later years the taxable profit will be greater than the accounts profit for the year, and the difference really relates to those profits in the early years that weren't taxed at the time. So in the early years there will be a deferred tax charge put through to the profit and loss account. In later years that deferred tax charge will gradually be reduced when the taxable profits are greater than the accounts profit. So that's basically what deferred tax is all about. And the provision for that tax liability will usually be shown in the statement of financial position as a non-current liability for deferred taxation. If you want to explore this a bit more, then in the text you'll find some examples of how the deferred tax is calculated. So compared to the tax standard, IAS 16 dealing with property, plant and equipment probably is the most complex standard as far as the exam's concerned. It contains more rules about calculations and so on than probably anything else. So just a quick reminder about what's included. First of all, to be included under this standard, it's got to be an asset, and remember, there's the important thing, it's got to be capable of generating future economic benefits for the business. It's got to generate basically an income in the future, one way or another, either by sale or by use to produce goods. So first of all, is it an asset? And then, is it property, plant and equipment? It will be dealt with under this set of rules if it falls into one of three categories. Firstly, the production or supply of goods or services, so machinery in the factory and so on. Or it's an asset used for the business of renting it out to other people, so companies that contract hire vehicles out, those vehicles in their books will be treated as property, plant and equipment. And finally, it's got to be used for admin purposes within the business, so computer systems in the office and so on. So that's a definition of the items included in this standard, and on the following slides we'll look at the rules that surround those. So firstly, very important to remember what we include in the cost of the asset in the statement of financial position, and remember that we include everything, all costs that were necessary in order to bring that asset to the point where it's usable in the business. All costs necessarily incurred up to the point where the asset's in a position to be used. So that will include things like legal fees, it will include delivery costs, it will include installation costs and so on. But do remember this, because it crops up from time to time. The one thing that is not included in the initial cost of an asset is the cost of training employees in how to use it. Training costs are never capitalized, they're always written off to profit and loss. But all the other costs, up to the point where the piece of equipment can be used in the business, all of those are treated as part of the capital cost of the asset. They all go to non-current assets in the statement of financial position and are subject then to depreciation. Any costs incurred after the initial purchase of the asset fall into two categories. If the costs are incurred simply to maintain the asset in good working order, then those costs are a revenue expense written off to profit and loss. But if as a result of incurring expenditure, then the future benefits from the asset are increased, so we've improved the value of the asset really, those costs will be regarded as capital expenditure. So watch out for that. Costs of maintaining the asset in good condition go to profit and loss. If any costs are incurred that are going to improve the value of the asset to the business, then those costs are regarded as capital expenditure. Now, when it comes to depreciation, it's really important to be clear about what it is. And remember, the cost of the asset represents the cost to the company of the future benefits that it's going to obtain from the use of that asset in the business. And the depreciation charge represents the cost of the benefits used up in the period. It's not an adjustment in any way relating to the current value of that asset. If we buy a machine and we use it for 12 months, if at the end of that 12-month period we could sell it for more than we bought it for, we're still going to charge depreciation on that machine based on the cost, because we've used up some of the benefits that that expenditure provided us with. So it's the cost of the benefits used up in the period. That's what the depreciation charge is supposed to represent, nothing to do with current values. And there are usually three ways in which that depreciation charge can be calculated. Firstly, and rather unusually, it can be calculated by reference to the actual benefits used up in the period. If we buy a machine that's capable of producing 250,000 units of product and we produce 25,000 units of product in the period, that's 10% of the total, so we would write off 10% of the cost. The depreciation would then vary each year depending on the number of products produced rather in that period. So we could work out accurately the cost of the benefits used up, but more often than not we'll either use straight line depreciation, and that assumes that the benefits are going to be used up at the same rate over the life of the asset. So things like leases and so on will probably be written off by way of straight line depreciation. Assets that are going to be more useful, produce more benefits in the early years than in the later years, maybe machinery in the factory that's going to work less efficiently in later years, is going to require more repairs and maintenance. Reducing balance depreciation will probably be more appropriate in that case. There'll be a greater use up of benefits in the early years than in later years. Now, it's important to remember that changes in estimates that have been used to work out the depreciation charge can occur. We might change the estimate of the residual value of the asset, what we can sell it for at the end of its life. We might change our estimate for how long the asset is going to be useful for. The important thing to remember here is that even if we now know that previous depreciation figures were incorrect based on the information that we now know, we do not change anything that's gone before. All we do is recalculate future depreciation based on the present written down value, the present book value of the asset from this point onwards. The depreciation charge gets recalculated. This does sometimes crop up in the exam. It's important to remember the calculation for that. We simply look at the current net book value and calculate a new depreciation charge based on that. The other thing to remember as far as depreciation is concerned is if we have an expensive asset, and part of that asset, a substantial part of that asset, requires replacement sooner than the rest. In that case, we have to split the asset into two and depreciate each part of the asset over that part's useful life. And this means that when that part of the asset is replaced, the cost of the replacement is not treated as repair and renewal expenditure. The cost of that part of the asset is treated, the replacement of that part of the asset is treated as the purchase of a new asset, and the old asset part that's been disposed of will be an asset that was written off. So we have to split assets into two parts where significant parts of the asset have different lives and depreciate each part separately. Remember that does crop up from time to time. Here's a question then for you to have a go at, just to make sure you're clear about those depreciation adjustments. Here we've got a company with a year end 31st of December. On the 1st of January 2017, it purchased an asset for £48,000, and this was being depreciated on a reducing balance basis at the rate of 20% per year. In January 2021, they reviewed the asset and determined that it now had a remaining life of 5 years with no residual value, and it should now be depreciated on a straight line basis at the rate of 20% per year. So see if you can work out what the net book value will be at the start of 2021 and what the depreciation charge will be for the year to the 31st of December 2021. So just pause the presentation for a moment and see if you can carry out those calculations. So the net book value at the start of 2021 and the depreciation charge for that year. So here's what the figures should be for the first few years. The asset was purchased for $48,000, and up until 31st of December 2020, we've depreciated it on a reducing balance basis at the rate of 20% a year. So those will be the depreciation figures up to December 2020, and on a reducing balance basis. So at the beginning of 2021, that will be the net book value after the £4,915 depreciation has been deducted from the brought forward figure. Remember, this was on a reducing balance basis. So £19,661 is the net book value at the start of the 2021 year, and we're now going to write that off. The remaining cost of the asset, the remaining benefits, are going to be written off over 5 years on a straight line basis. So that's 20% of that every year, and those are going to be the depreciation charges. For 2021 is $3,932, and that will continue for the remaining 4 years until the asset's finally written off. There's a rounding difference in the final year. So the important thing to remember, no adjustment to the depreciation figures that have gone before. We simply take the net book value of the asset at the start of the period where we know an adjustment's required and recalculate the depreciation from that point onwards as if it was a new asset purchased at that date. The other important area covered by IAS 16 is the revaluation upwards of assets. If we believe that assets are currently worth more than their book value in the statement of financial position, IAS 16 gives us the option of increasing that value. And remember that all assets of the same class must be revalued. You can't pick and choose. If you're wanting to revalue one branch of a business, you have to revalue all branches and so on. And for this purpose, the revaluation is the price that would be received if the asset was sold on the open market. So the fair value of the asset. And once we've carried out a revaluation, we must repeat those revaluations at regular intervals to make sure that we keep up to date with what the sale price of the assets would be in the current market. And for properties, that's usually a 5-year period. Now, when we come to account for the revaluations, the entries are relatively straightforward. Remember, we increase the amount in the asset cost account to reflect the new value. So we debit the cost account. We get rid of all the accumulated depreciation that might have been built up to date in respect of that asset by debiting the accumulated depreciation. And then the difference between those two figures goes as a credit to the revaluation reserve account, which is part of the equity section in the statement of financial position. And remember that the amount that gets credited to the revaluation reserve also appears in the statement of comprehensive income for the year. It doesn't go to the profit and loss account, that only shows realized profits, but it does appear in the statement of comprehensive income. So debit cost to increase the amount in the cost account to the present value, get rid of accumulated depreciation by debiting that account, and then put a credit entry through to the revaluation reserve. If there are future reductions in value, if we carry out an impairment review and want to reduce the asset's value, then before we take any reduction to the profit and loss account, we first of all eliminate the balance on the revaluation reserve relating to that specific asset, if there is any. One important thing to remember in the exams as far as revaluations are concerned, and one thing to look out for, is the date the valuation takes place. If the revaluation takes place at the start of a financial year, then you should make the revaluation adjustments as shown above there, and then calculate the depreciation charge for the year based on the new revalued amount. If, however, the question tells you that the revaluation took place at the end of the year, then you must remember to charge an extra year's depreciation based on existing values, and only after you've done that should you make the revaluation adjustment. So an important thing to consider there, and on the next couple of slides there's a couple of questions dealing with that. So here's the first revaluation question. We've got a company with a year end of 31st of December. They purchased a factory on the 1st of January 2015, depreciated on a straight line basis of 2% per year. In January 2021, the building was revalued at £320,000, and it was estimated that there were 30 years left and the building was going to be depreciated over that period on a straight line basis with no residual value. So based on that information, work out for the year 31st of December 2021 what the entries will be regarding the revaluation and what the charge for the depreciation in 2021 will be as well. So see if you can pause the presentation and see if you can calculate those figures now. So the first thing we need to do is to increase the factory cost account. At the moment we've got an entry in the cost account for 200,000. We want to change that to 320,000, and so we need to debit the factory cost account with an extra £120,000. We then need to get rid of all the depreciation that's been charged up to that point in time, and that was at 2% a year, and it was for 6 years. The first year was the year to the 31st of December 2015, and we've then got 2016, 17, 18, 19 and 20. So 6 years of depreciation to be eliminated. The difference goes to the revaluation reserve of £144,000, and that will appear in the statement of comprehensive income for the year. Now, because the revaluation was on the 1st of January 2021, right at the start of the year, that year's depreciation will be based on the new figure, and so the depreciation charge for the year will be 10,667. That's the revalued amount over 30 years. So here's another revaluation question. This time, company with a year end again of the 31st of December purchased some machinery on the 1st of January 2018, and that was being depreciated on a reducing balance basis at the rate of 10% a year. The machinery was revalued on the 31st of December 2021, so at the end of the year rather than at the beginning of the year, and at that time the machinery was revalued at £270,000, and that would continue to be depreciated at 10% on a reducing balance basis. So pause the presentation, see if you can work out this time what the 3 entries for the revaluation at the end of the year will be, and the amount of depreciation charged in the year to the 31st of December 2021. So this time we've got an asset currently recorded at 260,000 in the asset cost account. We need to increase that to 270,000. So there's going to be a debit to the cost account of £10,000. We then want to get rid of all the depreciation to date on that asset, and the important thing to remember here is that the revaluations after the depreciation for the year to the 31st of December 2021 has been calculated. So the adjustment here is a total of 89,414. There's how the depreciation has been calculated for those 4 years. And as I say, the important thing this time is to remember that the depreciation for the year to December 2021 has got to be calculated on the old basis before the revaluation takes place. So the total depreciation that we want to get rid of, 89,414, the balancing entry of 99,414 goes to the revaluation reserve, and the depreciation charge for the year will be this one based on the old values before the revaluation takes place. So 18,954 will be the depreciation charge for the year. So do remember, if the revaluation's at the end of the year, you've got to charge depreciation for that year first and then make the adjusting entries. One calculation that frequently crops up as part of question 5 concerns the treatment of leases, and this brought about a major change to accounting when the rules were first introduced, and is an example of the application of substance over legal form. And if you remember, although depending on the terms of the lease, the company renting the item never actually legally owns that item, for accounting purposes it's treated as if they do, and the transaction is treated as if the lease agreement was the purchase of the asset by way of a loan. And for accounting, that means that firstly, the item being leased is included in non-current assets, and it's included, as stated here, at the lower of two figures, either the market value of the asset, what you'd have to pay for it if you bought it outright, or the discounted present value of the minimum lease payments. So that's the total amount that would be payable under the lease agreement up to the point where it could be cancelled. And it's the lower of those two figures that's treated as the cost of the asset. That's the cost of the future benefits that are going to be obtained from it. And that asset's then going to be depreciated, as all non-current assets are, but important to remember this, the asset must be fully written off over the lease period. So if you're leasing an asset with a life of 10 years and the minimum lease period is only 5 years, then it must be depreciated over that 5-year period. The shorter of the life of the asset or the minimum lease period determines the rate of depreciation. And when we've debited that amount to non-current assets, then we've got a corresponding liability, and that's then split between current and non-current liabilities in the normal way, showing what's going to be repaid in the following 12 months and thereafter. All the payments under the lease, apart from any initial payment up front, are treated as part repayments of a loan, and so each payment consists of capital repayment and interest, and we'll look later at how those payments are split. And this is important to remember. Any payment made at the start of the lease is treated as a deposit, and it's deducted from the total liability. We'll look at that again later, because it's one thing that causes confusion in the exam, whether the payments are made at the start of the lease or annually after 12 months. So just bear in mind, if there's a payment up front, it's treated as a deposit that's deducted from the value of the asset, and doesn't include an interest element. So here's just a quick example to emphasize those points. We've got a car lease, and the outright purchase price of the car is £20,000. The lease requires 5 payments annually in arrears of £5,000, so a total of £25,000, and the discounted present value of those payments is £18,000. The car is going to have a life of 10 years and it will be depreciated on a straight line basis. So when that lease is taken out, the first entry will be a debit to the motor vehicles account for £18,000, not the purchase price of the vehicle. Remember, we take the lower of the purchase price and the discounted value of the minimum lease payments, which in this case is £18,000. So that's what will be debited to motor vehicles. There'll then be a corresponding lease liability, and in the accounts that will be split between current and non-current liabilities, depending on how much of the capital amount is going to be repaid in the next 12 months. And then as far as depreciation is concerned, the annual depreciation, remember it's going to be on a straight line basis, will be £3,600, because we're depreciating the asset cost, which we're taking as £18,000, but we have to depreciate it over the minimum lease period, which is 5 years, rather than the life of the asset, which is 10 years. So just watch out for that. It can give you an extra mark or two if there's a lease involved in a question. The depreciation has to be over the minimum lease period if that's less than the life of the asset. So that's just an example of the initial entries that need to be made for a new lease. Now, just to emphasize, the one thing that students get wrong in the exam is the calculations because of the payment date. Really important to make sure you consider this. If the payments are required up front at the start of the lease and then every 12 months after that, the first of those payments is treated as a deposit and deducted in full from the amount that's treated as being loaned. And interest will only be included in payments after that first payment. So the whole of that first payment is treated as reducing any capital amount. And if the next payment is then made after the end of the year, then an accrual will be required for the interest element covering that 12-month period. If the payments at the end of the 12-month period, then every payment's treated as being a part repayment and a part payment of interest. And again, if the first payment occurs after the year end, it's unlikely to be the case in the exam. But if the first payment occurs after the year end, then you'll need an interest accrual in the accounts. So provided you get the treatment of the payments correct, and particularly watch out for that first payment that's treated as a reduction of capital if it's made in advance. The other problem is the correct calculation of how much of each payment represents interest, and there are two ways of doing that. Firstly, the actuarial method, which is the most accurate method, and the amount of interest will be given to you in the exam as a percentage of capital outstanding. So that's fairly straightforward, and you won't be required to calculate the rate of interest using that method. But in the exam, it's more likely that you'll be asked to do a calculation using the sum of the digits method, and that's as the slide says, a less precise way of calculating the interest element of each payment, but it does take account of the fact that at the early stage of the lease, when there's more capital outstanding, the interest in those early years is going to be greater than interest at the end of the period. So let's have a look at an example of how that works. So here's a quick example of how this calculation works. We've calculated that the interest element, the difference between the total lease payments and the capital amount that we've treated as borrowing, the total interest is treated as £12,000, and there are 8 annual instalments payable in arrears. So each one of those will be treated as containing an interest element. Using the sum of the digits method, we can work out the interest in this way. First of all, we add up the number of instalments in this manner. So we've got 8 instalments. That gives us a total of 36. That's why it's called the sum of the digits. Or we can use this little formula, which is the number of instalments times the number of instalments plus 1. So that's 8 times 9 gives us 72. Divide that by 2 gives us 36, and that's the number that we use to work out the interest element. Now, on the first repayment, at that time there are 8 instalments outstanding, and so the amount of interest included in the first repayment will be 8 because that's the number of outstanding instalments divided by 36 times the total interest, which gives us an interest element of 2,667. The interest element in the secondary payment will be the total interest times 7 over 36, 2,333. The interest element of the third repayment would be 6/36. The fourth one would be 5/36, and so on. So that's how the interest element of each total repayment is calculated using this sum of the digits method. And there's a question on that on the next slide for you to have a go at. So here's a quick question on the sum of the digits method. Companies leasing an asset that's got a market value of £20,000 under a finance lease. Now, if you get a question like this and it doesn't tell you a discounted present value of the lease payments, then just treat the market value of £20,000 as the asset cost. And that's acquired under a lease over 4 years, and that requires payments of £6,000 in advance. That's the important thing to watch out for in these lease questions. There are 4 payments of £6,000 in advance. The first one's right at the start of the lease. So see if you can calculate, using the sum of the digits method, the capital and interest elements of each payment over that 4-year period. So pause the presentation now and see if you can work out those 4 calculations. So the first payment, remember it's in advance, is treated as a deposit. So that first £6,000 will be deducted from the 20,000, meaning that we've borrowed £14,000 that's going to be repaid by way of 3 payments of 6,000. So the total payments are going to be £18,000. We can then work out the interest included in each of those £6,000 payments. We take the total interest, which is the difference between the 3 payments of 6,000 and the capital amount that we've treated as being borrowed. So the total interest is £4,000, and on the first payment we multiply that total by 3/6. Remember, that's the number of instalments that are outstanding at that point, which is 3, divided by the sum of the digits, and that can be calculated using this formula here. The number of payments times the number of payments plus 1, so that's 3 times 4 is 12, divided by 2 gives us 6. So the interest included in the first repayment will be £2,000, so the capital repayment there will be 4,000. On the second payment, the interest element will be total interest of 4,000 times 2/6, gives us £1,333 interest. So that means that the capital will be 4,667, and the final payment of £6,000, again total interest times, in this case 1/6, because there's only one payment outstanding. That gives us an interest element of 667. Those 3 added together give us a total interest of 4,000 and a capital repayment total of 14. So that's how the sum of the digits method works. IAS 36 applies perhaps one of the most important accounting rules, and that's that assets must never be overvalued in the statement of financial position. Undervalue the assets, that's fine, but never show assets at more than the value of the future benefits that are going to be derived from them. And if the directors are aware or should be aware, given the circumstances, that there's a permanent fall in the value of company assets, then they must carry out an impairment review. It's got to be a permanent fall. If for some reason the property market takes a dip that reduces the current value of assets, but the market's expected to pick up again, that's not a permanent fall in value, so that doesn't require an impairment review. But anything that means the assets are going to be worth less than their figure in the statement of financial position means the directors are obliged to carry out an impairment review of the assets, because remember, the assets can never be stated in the statement at more than the value of the future benefits that are going to be derived from them. So the carrying amount mustn't exceed the maximum possible future benefits, and benefits can only be obtained in one of two ways: either by selling the asset, and so the future benefit there would be what it can be sold for less the selling costs, or the company can keep the asset, use it to make products that it's going to sell at a profit in the later years. And that's the value in use figure. It's the discounted value of future profits that can be attributed to that particular asset. And when we're considering impairment reviews, we take the highest of those two figures. So that's the maximum future benefit that we're likely to obtain from that asset, either by selling it or using it to generate profits. And we take the highest of those two and compare that to the carrying amount in the statement of financial position. Provided the highest of those two figures is the same as or more than the carrying value, then we don't require any adjustment. If we're showing the asset at less than its recoverable amount, that's fine, but we can never show it at more than that recoverable amount. If the figure in the balance sheet exceeds the highest of those two figures, then we've got to write it down to the highest of those two values, and the difference will be written off as an impairment loss to profit and loss. Just remember though, if the asset's been revalued previously and there's a balance on the revaluation reserve relating to that asset, that balance has got to be eliminated first before anything gets charged to profit and loss. So that's how IAS 36 operates. The next slide's got a question similar to what might crop up in task 5 of the exam. So here we've got 4 assets, and this is the figure from the statement of financial position, the carrying amount. This is what it could be sold for, less cost of sale, and this is the value in use. This is the discounted future profits that can be attributed to that particular asset. Now just pause the presentation and see if you can work out how much, if any, needs to be written off of those assets as far as an impairment loss is concerned. So the important thing is to look at the carrying amount and look at these two figures. If one of them is the same or more than this figure, we can forget about the asset because it's not overvalued. But in the case of asset number 1, we're carrying it at £10,000, but that's more than the maximum future benefit we're likely to receive from the asset. And the maximum future benefit in this case is going to be if we keep it and use it, which is going to generate £7,000 of profits. So that's the maximum future benefit. We can't show the asset at more than that figure, so we need to write it down by £3,000. That will be written off as an impairment loss. And then do remember we'll need to recalculate depreciation from this point onwards as well. The second asset is shown at 42,000. If we look at these two figures, the value in use figure's more than that, 44,000, so we can forget about it. There's no adjustment needed. £18,000 for the third asset. We could sell it for 12. If we use it, it's going to generate 10 of profits. Those are both less than the carrying amount, so we've got to write it down to reflect the maximum future benefit we could get, which would be from selling it. So we've got to reduce it from 18 to 12, so we've got to write off £6,000. And then finally, the carrying amount of asset 4, 67. We could sell it for more than that, so we don't need to make any adjustment. So that's the sort of table that you might meet in task 5 of the exam when you're asked to calculate an impairment loss. So there's a total amount of £9,000 here that would be written off to profit and loss unless any of those assets have previously been revalued, in which case some of that write-off would go to the revaluation reserve rather than profit and loss. So IAS 37, provisions, contingent liabilities and contingent assets, one that crops up in a lot of situations. Remember, first of all, the definition of a liability. There's got to be a legal obligation or a constructive obligation, and it's got to be as a result of past actions. There's an example of a constructive obligation. A company is saying that they'll exchange goods within 2 weeks of delivery if they're sent back in good unwashed condition. They have no legal obligation to do that, but there's a constructive obligation. They've always told customers that they will give that refund, and so that's an implied constructive obligation that they will comply with. And finally, it's got to be more likely than not probable that at some point the liability will require settlement either by payment or the provision of goods and services. So those three things are necessary for there to be a liability: legal or constructive obligation of past actions, and more likely than not that settlement will be required. If there is a liability and you don't know when that settlement's going to be or exactly how much it's going to be, then it's referred to as a provision. So a provision is a liability of uncertain timing or amount. Now, in both cases, all liabilities, all provisions must be included in the statement of financial position, and being a double entry, there's always going to be an effect on the profit and loss account as well. So liabilities and provisions all go into the statement of financial position. Contingent liabilities are pretty much the same, with one difference. There's still got to be a legal or a constructive obligation as a result of past actions, but if it's unlikely that settlement will be required, then it's uncertain. It's a contingent liability depending on the outcome of an uncertain event. So a contingent liability is the same as a liability that goes in the statement of financial position, with one difference. If it's more likely than not that settlement's going to take place, then it goes into the statement of financial position. If it's unlikely that settlement is going to be required, then it's a contingent liability. It doesn't go into the statement of financial position, but it does get disclosed in the accounts by way of a note, because remember, the purpose of those financial statements is to inform potential and existing investors, and those individuals would need to know whether or not there's a potential liability, even though it's unlikely that it will involve the company making a payment or something. That investor would like to know that there's that potential liability hanging there in the background. So that's the important things to remember about IAS 37, and the different treatment depends on how likely it is that payment's going to have to be made at the end of the day. We'll have a look on the next slide at an example of the type of question you might get in the exam on IAS 37. So here's the type of question you might get presented with in the exam. You've got 5 particular statements about liabilities or potential liabilities, and you've got to decide for each one of those whether it's something that needs to be reflected in the balance sheet, in the statement of financial position, whether it shouldn't be included in the figures but needs to be disclosed by way of a note, or whether it doesn't require any entries whatsoever in the accounts. So pause the presentation for a moment or two, have a read through those 5 items and think about which category each one falls into. So if we have a look at the first item, there's an ongoing court case, and if we lose the court case, it's going to cost us £2 million, but our advisors think that it's 70% certain that we'll win the case. Now, there's a potential legal obligation, and the court case is a result of something that's happened in the past, but it's unlikely, based on current information, it's unlikely that the result of that is going to be an outflow of funds from the company. And so this particular item requires a note to the accounts, because yes, there's a potential liability, yes, it's the result of something that's happened in the past, but it's unlikely that payment will be required, and so that requires a contingent note, but not an entry into the financial statements themselves. If it was likely that we were going to lose the case, then yes, we would need to record it as a liability. Second item, the directors are planning to pay a dividend of £5 per share. Now, in this case, until the payment of that dividend is approved by the shareholders at the annual general meeting, there is no obligation to make that payment. It's just a proposal. And so at the balance sheet date, there is no entry required whatsoever, because there is no legal obligation, there is no obligation arising from past behaviour that would lead people to assume that they're going to receive that dividend. So watch out for that. Proposed dividends do not get entered into the accounts at all. Occasionally in task 1 and 2, where you've got to prepare a set of financial statements, there might be a note indicating that the directors are planning to pay a dividend. Do not include that in the accounts as an accrual, because there's no obligation to make the payment. The obligation doesn't exist until the shareholders approve the payment at the annual general meeting. The third item, the company has signed a lease for a building that says when the lease comes to an end in 50 years' time, the building has got to be refurbished, and that's estimated to cost £30,000. So we've got a legal obligation that exists now. It existed the moment that lease document was signed by the company. So there's a legal obligation. It's the result of a past event, the signing of the lease, and it's absolutely certain that that item is going to have to be incurred at a later date, albeit in 50 years' time. There's no question about the fact that it's going to have to be incurred. The only thing that's uncertain, perhaps, is the actual amount of the cost of refurbishment, and so that arguably would be a provision, but in that case it still needs to go into the statement of financial position as a liability. In this particular instance, it would be discounted to a present value. So if at the moment it's estimated to be £30,000, maybe the discounted figure at the moment to be included in the statement of financial position might be 25,000, but then over the period of time between now and the end of the lease, that liability would gradually be increased until in 50 years' time it was in the accounts at a £30,000 figure. But it's definitely a liability because there's definitely an obligation, and it's absolutely certain that that cost is going to be incurred. The fourth item, the company's directors have agreed in a meeting to close part of the business and make redundancies, but nobody's been told about that yet. And that's the key thing. There is no obligation to undertake that closure. There's no obligation to make those redundancies. It's just a proposal at the moment. Until it's made public, there's no obligation to carry out that plan, and so no entries are required at the moment whatsoever, because it's just a proposal. It only becomes a firm obligation when staff have been notified of those plans. Up until that point in time, the directors can change their mind, and there's nothing anyone can do about that. And then finally, we've got a subsidiary company that's not trading profitably. It's likely to go bust owing 40,000. The parent company has guaranteed that £40,000 liability. Now, in this case, there's a legal obligation because the company's signed a guarantee. It exists at the balance sheet date, and it's more likely than not, bearing in mind the company's financial situation, it's more likely than not that the company is going to have to make a payment under that guarantee. So in this case, it goes as a liability in the statement of financial position. If the business was trading profitably, then it's unlikely that a payment under that guarantee would be required, and in that case it would be a contingent liability. So that's the type of question you'll meet in task 5. The main things to remember are, is there an obligation of some sort? If there's no obligation, there's no liability. If there's an obligation, how likely is it that the company is going to end up making a payment or a transfer of resources? If it's more likely than not, then it needs to go as a liability in the accounts. If it's unlikely that a payment will be made, it's a contingent liability. Now, IAS 37 also deals with contingent assets, and the treatment of those is very different from liabilities. Remember, as far as assets are concerned, we never include an asset unless it's absolutely certain, not likely, but absolutely certain that value will be received. In the case of a liability, it's included if it's likely, if it's more likely than not that a payment will be made, we need to include the liability. But that's not the same for an asset. We only include an asset if it's absolutely certain, without doubt, that an amount will be received. So the rules for assets If we're certain the amount will be received, whether it's an insurance claim or whether it's a court case that's been decided in our favour, if it's certain we're going to receive this amount, then we show it as an asset in the statement of financial position. If it's likely that we're going to receive the amount, we still don't include it. We only include a note about that potential asset in a note to the accounts. If we're uncertain whether or not a receipt's going to be received, then it's ignored altogether. So very different criteria for assets compared to liabilities. The general rule is that we never include an asset unless we're certain that we're going to get some benefit from it in the future. We always include a liability if it's likely that we're going to have to settle that liability at some stage. IAS 38 deals with intangibles, and two intangibles in particular, research and development and goodwill. Here's the definition: an identifiable non-monetary asset that has no physical substance, so you can't carry it away with you in the back of your van. So that would cover leases, it would cover goodwill and so on. We only include intangible assets if certain criteria are met. First of all, it's got to be identifiable as a separate item. In other words, it could be sold to someone independently from an entire business. It's got a life of its own, so it's a separate identifiable item. Secondly, it's got to produce, as with any asset, future economic benefits. And thirdly, and most importantly, its cost, the cost of the intangible, can be accurately measured, and it's that final criteria that results in several assets being excluded from the accounts because we can't accurately measure the cost. And once we've included an intangible asset, then one of two things happens. If it's an intangible asset with a finite life, so if it's a lease for 50 years, it needs to be depreciated over that 50-year period. If, however, it's an intangible that doesn't have a set period of time, if it's likely to exist ultimately forever, then those intangible assets must be subject to an impairment review every year, and that particularly applies to goodwill. That needs to be reviewed to make sure that the future benefits, remember the future economic benefits, are at least equal to the value shown in the statement of financial position. And goodwill, remember, internally generated goodwill and other assets are never included in the statement of financial position because the cost cannot be accurately measured. That's one of the criteria for inclusion. We can't measure the actual cost of generating goodwill internally. It's a byproduct of all the things we do. Purchased goodwill will appear, so that will only be the case if we've purchased an existing business or an existing brand and so on. That will be included at a cost that can be determined, the price that we paid for it, and that has to be subject to an impairment review every single year. Now, one particular item that crops up a lot in the exam is the question of research and development costs, and two different treatments. If it's research expenditure, and there's the definition from the standard, original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. That's research expenditure, and that is always written off to profit and loss in the period incurred. It's never treated as an asset, even though we've acquired important new knowledge. It's never shown as an asset. The costs of research always written off to profit and loss. Development expenditure, once we've got that knowledge and we're going to now use it to probably make a new product, there's the definition. The application of research to plan or design a product or make changes that improve existing products. That's development expenditure. And the cost of that must be capitalized. There's no doubt about it. It has to be capitalized, but only if a whole set of criteria are satisfied. Firstly, it has to be shown that the company is going to obtain future economic benefits as a result, either by using the item that's been developed within the business or selling it at a profit. It's got to be shown that the item that's been developed will produce future economic benefits. Secondly, it's got to be shown that the company's intention is to fully complete that item and either use it or sell it in the business, and most importantly, that the company has got the resources, including the finance necessary, adequate to complete it. So if it's a new product and the company needs to set up a new production facility, has it got enough money to purchase all the equipment, all the machinery needed for that? If it hasn't, then that requirement isn't met. It's got to have all the resources necessary to be able to complete that item. Is it a saleable product? Is there a market for it? And is it currently technologically feasible for that product to be completed? So we might develop a new type of vehicle, but we can't put it into production until somebody else comes up with a new particular piece of equipment that's required to make that vehicle roadworthy. So the technology's got to be there already to be able to make and sell that product. And any costs related to the development need to be able to be measured accurately. So it's not just one of those 6 items that has to be satisfied. All 6 items have to be satisfied before the development expenditure can be capitalized, and this might crop up as a written question in task 4 of the exam. You've got to determine whether some development costs can go to the balance sheet or get written off to profit and loss. So you need to remember these 6 items. Are there going to be future benefits? Has the company planning to complete the item? Has it got the resources to do so? Is it a saleable or usable item? And is it technologically feasible to complete it, and can we measure the expenditure? All 6 of those items have to be satisfied before the item goes into the statement of financial position. Once that's done, then the expenditure's written off over the life of the product. So if we're producing a new vehicle that can be sold for the next 8 years, then that development expenditure, once capitalized, will get amortized over that 8-year period, written off to profit and loss. So that's research and development, something that's a popular topic in the exam. So the last standard you're likely to come across is the standard that deals with when sales should be recognized in the profit and loss account. That's IFRS 15, and there's guidance given on both the sales of goods and the provision of services as well. In the case of sales of goods, you should only recognize a sale when all the risks and rewards of ownership have been transferred to the buyer. So if that particular item was lost or destroyed, then it would be the buyer that suffered the loss, not the supplier. The seller has no further control over the goods. The buyer is free to do what they like with them. The value of the goods can be measured. It's probable that economic benefits will flow. In other words, the supplier is going to get payment for those goods, and costs relating to the transaction can be determined. So all of those requirements need to be met before a sale can be recognized in the profit and loss statement, and these first three are the most important ones. The seller has no further control over the goods and has no risk or liability as far as the goods are concerned. Once that point's been reached, then the sale can be recognized. In the case of services, again, provided the revenue can be measured, it's probable that the business will receive payment for the services, and the stage of completion can be determined at the year end. Costs to complete can be measured reliably as well, and where services are 100% complete by the end of the period, all of the revenue can be recognized whether or not the customer has been invoiced. So that would be particularly relevant in the case of an accountancy practice where work is partially complete at the end of the year. Should you recognize the value of work done up to the year-end date on a particular client's books, whether or not the job is complete at the end of the year? IFRS 15 says that you should include part of the fee for that job, provided you can estimate the point at which it's been completed and what the total revenue is likely to be. So sale of goods, provision of services, IFRS 15. There are two particular situations relating to this that I'll deal with on the next slide. Now, the first of these two situations concerns consignment stock. This is where stocks of usually raw materials are delivered to a customer's premises well before they're actually used by the customer. So stocks delivered very early to the customer. There's advantages there for the customer because the stock is on site, so when they need those materials they can access them very quickly, and there's an advantage for the supplier as well because there's less storage required if those goods are stored on the customer's premises rather than on their own. So there's advantages to both parties in consignment stock. The important thing to note is that with consignment stock, it remains in the ownership of the supplier until it's actually used. So all the risks and rewards of ownership still rest with the supplier. That means that the stock must still be included in the supplier's inventory at the year end. Even though it's not on the supplier's premises, it's still an asset in the supplier's balance sheet. It's one of the problems that auditors encounter where there's consignment stock, because it's necessary to go to lots of different customers' premises to inspect that stock that's still part of the supplier's inventory. And it's important to note that it's not part of the customer's inventory, something again auditors need to make sure of, that it's not included both in the supplier's balance sheet and the customer's balance sheet. So the stock, although it's on the customer's premises, it still remains in the ownership of the supplier until it's actually used. So the customer's invoiced when the stock is used. That will mean either, in some cases, the supplier will go and do a stock take at the end of each month. I've encountered that in the past, and the customer gets invoiced for the material used during the month, or the customer supplies information, if it's a trusted customer, supplies usage information to the supplier so that an invoice can be raised. So consignment stock has lots of benefits to both parties, really. But just note that important thing, it's still part of the supplier's inventory at the year end, it's not part of the customer's. And then goods on sale or return can sometimes be a problem where goods are supplied to a third party, and if they're not sold within a certain time, they can be returned to the supplier and full credit can be given. Then sale should only be recognized either after the return period expires, so if goods are sold or goods are supplied on the basis that they can be returned within 30 days if they haven't been sold, if the customer still holds on to those at the end of the 30-day period, that's when the sale can be recognized. So when the return period expires, or if it's earlier, when the goods are sold. So those are two particular situations where IFRS 15 does have a bearing on the accounting treatment, and watch out for those because they may well crop up in the exam, particularly the consignment stock question. Now, just a final note here on answering written questions, and this is where students lose marks unnecessarily, and a lot of the questions relating to accounting standards will take the form of written questions either in task 3 or in task 4, and I would suggest you adopt this approach. First of all, when you read the question, think about which accounting standard or which accounting standards are relevant to the question. What's the examiner testing your knowledge of with this particular question? And once you're aware of what that particular standard is, then jot down on a scrap of paper everything that you can remember relating to that particular accounting standard. If, for example, it's IAS 16 and property, plant and equipment, think about the definition of property, plant and equipment, think about what depreciation is, what the rules are for changes in the expected life of assets and so on. Think about the splitting of assets where parts of the asset have got different useful lives. Think about the rules regarding revaluations and so on. Just brainstorm that particular standard, jot down all of the rules that you can think of relating to that, and then set about answering the scenario question, making sure that you incorporate as many of those rules into your written answer as possible, but at the same time making sure that the answer is specific and relevant to the scenario that you're presented with. Excuse me. For example, if under IAS 16 a company wants to know whether it can capitalize the cost of a particular asset, then you can answer that and you can include details of the items that can be included as cost. Remember, never training, but all the other expenses up to the point where the asset's used. So you can incorporate that, and in your written answer you could go on to say that if at a later date the directors wish to revalue the asset, then there are rules regarding how that can be done. Remember, all assets of the same class have to be revalued. So that's just a suggestion to approaching those written questions. What are you being tested on? Think about all the rules that are relevant to that particular area, and then incorporate as many of those as you can in the question, but always make sure that the answer's relevant to the particular scenario that you're presented with. So just in summary then, a reminder of the mistakes that students make according to the examiner that lose marks unnecessarily. Task 3, remember, is primarily about the conceptual framework, basic definitions of assets, liabilities and so on, and some ethics. Firstly, losing marks by not explaining how the frameworks and ethical principles relate to the specific circumstances. As I said in the previous slide, it's important not to just regurgitate a textbook. You've got to apply the rules to the particular scenario in the question and explain how they impact on that particular situation. Here's an important one, not taking account of the marks available for different parts of the task. So maybe in a particular question, part A might be worth 1 mark. That indicates that a very brief single item answer is required. But if in part B of that question the answer is worth 5 or 10 marks, that's a good indication that a much more detailed, more comprehensive answer will be required. So watch out for that. And finally, in task 3, not reading the question properly as always. Task 4, which is usually a written task, not explaining the accounting treatment in sufficient detail. Again, this goes back to the previous slide. Jot down all of the rules and regulations that are relevant to a particular accounting standard and make sure you incorporate as many of those in the answer as you can. For example, if you've got a question that asks you to explain how much of the costs relating to a new asset can be treated as capital expenditure, remember everything except training costs usually. You can incorporate those in the answer, but then you could expand your answer and explain that if at a later date the life of the asset is determined differently, how that will affect the depreciation charge. You could also go on to explain how, if at a later date the directors want to revalue that asset, what the rules are and so on. So once you've reminded yourself of all the rules in a particular accounting standard, make sure you try as far as you can to incorporate all of those in the answer, but always relating them to the particular scenario. And as the note here says, once you've done that, then take time to work with the numbers that you're given to actually work out the calculations, work out the depreciation, work out what the cost will be, and so on. So as I've said before, don't write a textbook, relate it particularly to the scenario and work with the numbers that you're given to give examples of how the rules will apply. Here's a problem, sometimes apparently stating various mnemonics without explaining what each element means. So things like the pest analysis, things like, if you remember in accounting systems and controls, you had spam soap to remind you of the different types of controls. Apparently students sometimes write those down without explaining what each letter stands for, so just watch out for that. Again, not taking account of the marks available. If it's a 2-mark question, then you're not going to need to write as much as if it was a 10-mark question. If it's a 10-mark question, then there are probably at least 5 points they're looking for, each of which would be worth 2 marks to give you the 10 marks. And finally, task 5, which is usually calculations, again not applying the rules to the particular scenario and so on. So hopefully you found these slides a useful reminder of what you should have covered already in your studies and the calculations that you might encounter in the exams. Do remember particularly that examiner comment about relating rules and regulations to the particular scenarios that appear in the questions. So hopefully this will have helped you get a few extra marks in tasks 3, 4 and 5 of the exam. So good luck with those.